Let's talk about financial software company Robinhood's IPO, including how we can do research on the deal so we can decide whether or not to invest in an IPO. And we'll also talk about how investment bankers value an IPO. Now, the first place you start when doing investment research on an IPO is the government's Securities Exchange website, meaning sec.gov. So let's go there together. And then what we'll do is we'll go to company filings, more search options, company name. And if you don't know the name of the ticker, you can always type in the company name here. Robinhood Markets. Go. Okay, great. All right. Now, what you'll see here is a bunch of financial documents. And this here is the S1. This is the most important document you can ever read. And this here is the document that investment bankers and lawyers create so that investors can actually understand the deal. And I'll go through this very, very quickly. So right here, this is the S1 filing. And this means this is the amended S1 filing, meaning they made a couple changes to it. Usually what they do is there's a bunch of versions of this before a company goes public because they have to update the price of the deal or the pricing range. So if we click here and we go into the document, again, I'll go through this very, very quickly. I'll show you a couple of the highlights. Now, the S1 is the most thorough document you will ever find on a publicly traded company. And it's even more thorough and helpful than reading the annual or the quarterly reports. Now, if we scroll down here, we can see here, and I'll zoom in a bit here so you can see it a bit better. The maximum price right here is 42 bucks, okay? The maximum price when they go public. And there are exceptions, which I'll talk about in a second. And the maximum offering amount of shares is 60.5 million shares. Okay, that's the highest number of shares they can sell in this IPO. So if we take 60.5 million shares times 42 bucks, then what happens is it shows that they're actually going to be raising $2.5 billion in this deal, which is a massive, massive deal. Now, if we scroll down, we see here that they're officially offering 55 million shares. So why does it say 55 million shares here? And up here, it says 60.5 million shares. Well, the reason is because if demand for the IPO is off the charts, then the investment bankers can decide to sell an additional 5.5 million shares. Now, in the first sentence here on page 2, okay, we see that that the company is of the 55 million shares the company is offering, what they're doing is they're actually going to be selling new shares, okay, 52.4 million shares. And these new shares, the 52.4 out of the 55 million, these new shares are called primary shares. And the money they raise from selling the 52.4 million shares will be used for general corporate purposes, which means they're going to use the money to grow their business by opening offices overseas, etc. Then, if we take 55 million shares minus 52.4 million shares, we see that there's actually, I think it's about 2.5 million shares that are being sold here it is here, 2.6 million shares that are being sold as well. Now, those 2.6 million other shares being sold in this IPO, they're not primary shares. Rather, they're secondary shares. And this means that employees and some early investors can finally get paid by selling their shares in this IPO. Now, we see here that in the next sentence that the range here of the IPO is going to be between $38 and $42 per share. How do investment bankers and their equity capital markets partners, how do they know that the price should be between $38 and $42? Well, what they do is they often look at the valuation of similar companies to Robinhood with similar growth rates. And then they calculate the proper offering value of the company, okay? And when they value the company, they value it a little bit below, sometimes 25 or 30% below what they think it should be valued at. And they do this to incentivize people to want to purchase the IPO. Otherwise, what's the point of investing in the IPO if it's not sold at a discount to the valuation? So the way they come up with a proper valuation is they usually use 3 different valuation methodologies. And they use 3 different valuation methodologies to come up with a target price. Then they take the average target price of those 3 valuation methodologies in order to minimize the margin of error if one of the valuation methodologies is way, way off. For example, they can use a price to revenue target price methodology if the company is not yet profitable. They can also use a DCF or discounted cash flow valuation and an EBITDA-based valuation metric, which is kind of like a PE multiple before accounting for non-cash items like depreciation. So why is the offering range between $38 and $42 per share? It's because the investment bankers don't know exactly what demand might be for the stock before the IPO. And the way they decide what the final price should be on day 1 of the IPO is for a couple weeks before the IPO date. What happens is this. The investment bankers have the management team of the company going public, Robinhood in this case. They have the management team meet with the largest mutual funds, pension funds, and hedge funds in the world on what is called a road show. So the investment bankers go on the road with the management of Robinhood, and they show the management team to investors all over the world or using Zoom, given COVID in some countries. Then after each meeting, the people that work with the investment bankers, who are referred to as equity capital markets or ECM, the people that work with the investment bankers will talk to all investors. And they'll say to the investors, hey, what did you think of the meeting? And how many shares do you want to buy? And at what price? Do you want to buy it at 38, 42, or somewhere in between, or even higher? Now, if it's a very, very hot deal, meaning demand for shares is way higher than supply, then the bankers, what they do is they often increase the pricing range to above $42 per share. And then they sell more than the 55 million shares. But it gets really, really tricky for the investment bankers, as quite often what happens is this. Mutual funds and hedge funds pad their orders by saying they want to buy way more shares than they really want. It's a game, and they use a lot of game theory too. So in a very hot deal, you never get all the shares you want ever. And I remember years ago when Facebook went public and I worked at a hedge fund, one of the investment bank employees during the IPO called me and said, Chris, I fought really, really hard for you, and you're going to get 100% of the shares you asked for. So on the phone, I told the investment bank employees, thank you. Then I hung up the phone and I told my trader at the hedge fund to immediately sell the shares that morning at the open. And quite often investment bankers will give the shares to firms that hold the shares for a long time. Okay, they want long-term shareholders. They don't like volatility. Now what happens is this. By law, very large hedge funds and mutual funds must report every few months to the general public how many shares they own of companies. Now, there's ways around this though, as what happens is this. Hedge funds often use put options to protect a large position that they want to sell, which is something I'm going to discuss in a lot more detail in my upcoming complete options course, which of course will be in my MBA degree program in much more detail. Now, if you've signed up for my MBA degree program, you get access to all additional lectures I add forever. And I'm going to add the options stuff right after class number 89. There's 100 classes in the deal, or in the program. So if we move down, and I'll wrap this up quickly, but if we move down here to the bottom of page 2 of this S1 filing, right here, here's the bottom of page 2. We see a bunch of investment banks right here that are doing the deal. Now, why are there so many investment banks doing this IPO? because it takes a lot of investment banking trading floors to distribute a large deal at the right price all over the world, which is why we have Mizuho from Japan in the middle here as part of the investment banking syndicates. You'll see here that top left, as they call it, top left here is Goldman Sachs, okay, which means they're the number one firm on the offering. The number two firm on the offering is top right here, which is JP Morgan. And the two most prestigious firms to be number one are often Goldman Sachs and Morgan Stanley. Morgan Stanley's awesome. Now the next 9 pages here, which I won't go through, but the next 9 pages here are what they are they're slides from presentations that the company gave during the roadshow, right? Meaning the presentation slides that they showed investors. And one last thing I want to mention, the last thing here is, let me get to table of contents here really quickly. Sorry for scrolling a lot. There we go, cool. The last thing I want to mention here is a table of contents where you'll find all the awesome information you need to know about this company in order for you to make an informed decision whether or not to invest in the company, including the market size, the risks, the competition, the management team, and of course, the historical financial statements. So the bottom line is I strongly and humbly recommend reading these S1 filing documents thoroughly before deciding to invest in an IPO.